our June Empowerment Sunday. If you are watching us online, we welcome you to our June Empowerment Sunday. And this is the last Sunday of the month of June. And today we'll be discussing a very important topic: investment, mortgage investment. This is a very vast topic, but we are going to focus on first-time home buyers. Even those of you that already have an existing mortgage, you still benefit from it. And for us to have this discussion, I have a friend of mine, a colleague in the mortgage industry, who have been practicing mortgage for the past 16 years. He is originally from Argentina and has lived in this Nashville community for the past 15 years. Practicing mortgage for the past 15 years. And he has been with Pinnacle Financial Partners for 10 years. He has helped a lot of clients finance their mortgage 100%. And I believe he will help us today for those that are interested in investing in mortgage, for those that are interested in buying their properties, their homes, and for those that already have their existing home. You will be blessed. You will be blessed in this program today. So I'm just going to be asking quick questions, and the audience will have the opportunity to ask questions as well. His name is Luciano Scala, and I'm glad to have you today to address issues concerning mortgage investment.
Thank you for having me. Appreciate to be here.
The first question I'm going to ask you is about some terminologies used in these transactions. We have some people that are not familiar with mortgage. So before they get confused, I want you to explain some concepts, some things like, what do you mean by mortgage? What is equity? And what is earnest money?
Well, we'll start with the earnest money. That's when you write an offer, you give some money to the seller to show them that you're serious and for them to hold the house for you and not accept any other offers. Equity is what one builds over time when the value of the house goes up. So let's say if you buy a house for 100, and then with time that value goes up to 150, that 50, that's the equity that you have in your house. It's the appreciation, or the more you pay towards the principal and more the value goes up, that difference between what you owe and what is worth, that's the equity of your house. And then mortgage insurance is when people don't put 20% down, the banks require this insurance to cover that difference over the 80%, just in case if someone is not able to pay off the house.
Thank you so much, Mr. Luciano. I believe I had a discussion some time ago on real estate, and some people do not understand some terms you are talking about. That's why I asked him to explain things like equity, things like earnest money. Thank you for the explanation on those subjects. The second question I want to ask you is, what are the benefits for investing in mortgage or buying a house instead of staying in an apartment?
Well, the biggest benefit is building wealth, okay? If you're renting, yes, you can move around, you can do whatever you want and have that freedom that if you don't like a place, you can move to the next one. But with time, you're not building any wealth. Your money is going to somebody else's instead of you paying something of your own. So buying a house is the best way to create generational wealth, things that you can pass on to your family with time that don't lose value. Houses, if you keep them in good condition, appreciate, continue to grow the value over time. Sometimes the economy might slow down a little bit and values might go down, but eventually, always real estate has gone up. So it's the way to build wealth.
Thank you so much for that. It is so much advantageous if you have your own house, you have your peace of mind, you know how much you are paying every month. Every month, you know your mortgage is 1,500. Nobody is going to expect you to pay more than that. If you pay more than that, that is helping you towards your principal, for instance. That reduces your eventual balance or on your property. So you do that at your own way. But if you live in an apartment, for the first contract of 1 year, they may ask you to pay 1,500. The next year, you are going to sign the lease or renew the lease. The owner will ask you to pay maybe 1,700. You have no choice. But when you have your own home, your own property, you have peace of mind, and nobody will harass you anytime, any day. So it's very advantageous for you to have your own home, have your own mortgage, and have your peace of mind, and fulfill the American dream. It's a dream everyone wants to fulfill. You know, to be able to own your own property, live in your own house, do whatever you want to do. Praise the Lord. I'm going to give the audience a opportunity to ask questions. We have several questions for him to deal with, so that at the end of this period, we'll have cause to have learned one or two things. So the other question I want to ask you is that, what are the key differences between loan programs available, especially for first-time home buyers? What are the key differences?
The main difference is between the rate, the down payment, and the requirement documents that you might have. You have basically the government loans, or FHA and BA, that are more flexible for people that their credit is not that great. But then if you want to qualify for the best options, conventional is another type of loan, but it requires higher credit score and maybe a little bit more down payment. Then another option that people have is when some banks will have portfolio loans that they create specifically to help first-time home buyers. Like my bank has 100% financing for people that have a challenge trying to save money to be able to buy a house.
Thank you. This 100% financing for some buyers are very, very interesting. What that means is that you don't have to save $10,000 before you buy your first-time home. Some people would like to save so much money to buy their home, or some people would like to say, oh, I want to live in Franklin, so I'm going to save, $10,000 before I can, try to buy a property in Franklin. But with this 100% financing, if you qualify for it, you may only bring nothing, or $1,000 or $2,000 to closing. I have an experience of a first-time home buyer that bought a house recently, not through him, through his assistants. And at closing, she only paid less than $600. Of course, at the beginning, you have to pay earnest money of $1,000. And then you do a home inspection as well. So that may cost you $1,300. Then at closing, so they have programs that will help you, that with little or no money, you will be able to be a property owner, a landlord, or a landlady. So thank you for that explanation. I want to pause a little bit. We have several other questions for him. If any member in the audience have any question from what he has said so far, it's up to you at this time.
Good morning. Thank you for coming here today. I want to ask, you said 100% finance. Does that have anything to do with your credit score? Is that part of the qualification, like 700, 750?
Yes, for the 100% you need 650. So every program that you applied for has a minimum credit score requirement.
And what percentage would that be on top of the mortgage that the client will have to pay?
Even the interest rate?
Yes, the interest rate, the percentage.
The rate on that loan goes from 7% to 7.5%. The thing with this program is that it doesn't have the mortgage insurance. So by not having the mortgage insurance, even though the rate is a little bit higher, the payment at the end is kind of similar if you go with a conventional or an FHA loan.
A follow up to that question. Um, does that have like income limit? Like you have to earn so much, or what? How does that work?
Yes, all the loans for first-time home buyers, all the ones that have some kind of help, are designed for people with certain limit of income. So on
And
that
what would
one
that
is
limit be?
it's 80,400.
And below?
Yes.
Femi, before we go to next questions.
Morning. I want to ask a question. I know this is no the this section is mostly for first-time home buyers, but I have a question. So, what about for investment property like fourplex, like probably 8 units? Do you also, render such services for investment properties?
What I do is residential mortgages. So, for investment properties, I can go to quadplex for 4 units. If you want to go for more than 4 units, that becomes to be a commercial loan. It will be a little bit different. But with mortgages, you can do, like I said, 4 units, and you need 20%. No, well, 20% down if it's 1 unit, 25 if it's two or more. 25. Yes. Yes. Okay.
Yeah, we have a question on that for him later on. Thanks for asking. So our next question for you is, what are the down payment assistance programs that are available for first-time home buyers?
The state of Tennessee has an organization called THDA that offers down payment to everybody that makes less than 130,000, but the down payment has a monthly payment, so it limits you a little bit on what you can qualify for. Then each bank, like mine, will have their own program. In my case, we offer 4.5% of the purchase price up to 15,000 without a monthly payment. But it is a loan that eventually you have to pay back.
Someone has a question? Okay, go ahead.
I have two questions. One, I want to find out from you what is it right for us to say? Is it right for us to say that the NS money is a commitment money? And what happened next if it happens that the transaction breaks down along the line? Is it refundable? That's question one. Question two, the applicable interest rate, is it fixed or floating? Applicable interest to the mortgage,
Well,
is it floating or fixed?
the earnest money, there's certain conditions on the contract that as long as you meet those conditions, they will refund you the money if the contract is canceled. But if you cancel it just because you don't want to do it, you don't want to go through with the transaction without any justification, then you can answer that question. Most probably the seller will keep that money. That's the purpose of the earnest money, to protect also the seller. But if there is a reason why you're canceling, like the home inspection, or you didn't get financing, then yes, you should get your money back. In terms of the rate, it will depend on what kind of loan program you do. Um, FHA, conventional, the portfolio loan, each one has a different rate, and like FHA will give you the rate no matter what your credit score is. It's almost everybody gets the same rate, but conventional, the higher your credit score, the lower the rate. So it's hard for me to tell you a specific rate today without knowing credit score, down payment, what kind of loan you're going to do. I can tell you that rates now are between 6.25% to 7.5%, depending what kind of loan program you do.
Thank you. For the earnest money, there's always a contract that you sign at the beginning of the transaction. So you just have to make sure you follow the due process. You make sure you follow what you sign, every condition that is there. The agreement, the purchase is subject to some conditions. So the most important thing is financing. If you do not get the finance, you do not get approval for the loan because of any reason, you get your earnest money back. Or if at the time you make the offer, the property is supposed to is valued for $200,000, and by the time it's appraised, and it's appraised for $190,000, that is a ground for you to say, I can't continue, except you will negotiate, and then we have a deal. So there are grounds where you will be qualified to get your earnest money back. It's not lost. I have someone raising hand to ask a question. Go ahead, sir.
Yes, sir. You were talking about the down payment being financed, right? If I had you right. Is that not going to put an extra burden on the mortgage itself on the person purchasing the house? Because if you are only financing 4.5%, as you said, and you are adding that to the mortgage payment, is it not going to be too much for the first-time home buyer?
You're talking about the 4.5% down payment assistance? It doesn't have a payment. The idea that my bank has and some of other banks is not to put more pressure on a home buyer, on the first-time home buyer, because we know that sometimes they don't have the funds, or they work hourly, and they might not have that disposable income to have a higher payment. So the idea is that it doesn't have a payment. The client doesn't have to give it back until they sell, refinance, or after 30 years, after they pay the first mortgage completely, that's when the client just starts paying that money back. But it's still without interest. For the life of the loan, it doesn't have a payment or interest for the 30 years. So the idea is not to put more burden on top of what a client has to pay.
Okay. I think one of my clients who bought a property had that kind of assistance, and I think what she got was about $12,000 assistance for that purchase, and she doesn't have to bother about it until after 30 years, or except if she decides to sell the property. That's when she has to pay that money back. All right, let's go to the next question. The next question for you, Mr. Scaler. And this is for those that already have properties. You already have your primary home of residence. That is good. But that is not the end of it. You have the opportunity to go beyond your residential property. You can as well buy an investment property. You can buy a property that you can rent. Some people come together and buy estate, buy apartments, all those rising big properties we see in downtown. Some people buy it. So the question I have for you is this. For those that already have their first primary residence, what is required if they wish to purchase additional property or buy investment property? And what are the benefits?
If you want to buy an investment property, the key difference is the down payment. You got to have 20% down. And if you want to be able to get the best rate possible, then you have to put 25% down. The more down payment you put on an investment property, it is beneficial because it will give you the lowest rate. The requirements are always the same when you're buying a house. It doesn't matter if it's investment or primary. We have to check credit, income, make sure that you can qualify for both houses.
Question? Any question? Go ahead.
Yes, sir. Good morning. Thank you very much, sir. So relating, you just started talking about some of that actually. So PTI, debt to income ratio, and also how much one should really consider from one's gross or net income to be able to properly buy a house and not be house poor. How much would you suggest? Firstly, the debt to income ratio. What should that be, or what for your bank or some other banks, or they go with, and then for someone not to be house poor, home poor, how much should one not go beyond in one's overall gross and net income to make sure that one is not house poor?
The answer for the guidelines is that the guidelines will allow you to go up to 45% of your income, of your gross income, and sometimes all the way to 49 or 50, depending on the loan type. That answer is the guidelines. If you're asking me personally what I would recommend people, I would say between 30 to 35% of your income. That way, you have the ability, if anything happens, you're not like cash poor, or you also have the ability to pay extra and pay off the house faster. Because if you put yourself in the limit and anything happens, then you're going to struggle and lose the house. The idea for me always is to help people. I tell them, you might qualify for this payment, but you got to tell me what payment is good for you. People have to make a budget, analyze their expenses, what they like to do besides having a house, and determine then what the payment is going to be. But for me, it's between 30 to 35.
Yes, sir. Somebody want? Okay.
I just wanted to get specifics on how they assess like income. Say, for example, last year I worked a job, but this year I'm an entrepreneur. How do they typically assess that? If you know.
When you're self-employed, there's two type. If you're self-employed is one thing, W-2 or hourly is another. Self-employed, we need 2 years of tax returns, period. And we'll look at those taxes and we'll use the average of the last 2 years. With W-2 work, it doesn't matter what you made the year before or the other year. What matters is what you're making now. We'll look because maybe before somebody was making $10 an hour and now they're making 15. And so what matters is now. Also, when you are W-2, you might have bonus or commission, and so we have to look at what you're making now compared to what you made in the past.
One more question before we continue. Go ahead.
Hi. So we're talking about investment properties specifically. I was curious to know if there's anything that we could be intentional about to make sure that these properties actually grow in equity as an asset.
I'm trying to think what you can do, but it is the main thing for some, is to keep the value, is to maintain the property. The condition, do upgrades, and that way you can generate more rental income from them, and keep appreciating them. The condition is the key.
Okay, Mr. Luciano, I have a question for you. What are the advantages for mortgage refinancing, and what is the process?
For me, the would be to lower the rate. Right now, we're in a moment in the economy that the rates are higher. So in a year or two from now, it's going to be where rates are going to go down, and people will benefit from lowering the rate. You got to be careful because there has to be a benefit. Your payment reduction, you got to recoup those closing costs pretty fast to make it worth the refinance. So a lot of people sometimes do cash outs. I'm not really a fan of the cash out when people take money out of the value of the house, because that means that you never paid off your house. You're stretching the debt more and more. But the true benefit of a refinance is to lower the payment or reduce the term that you have left on your house.
Can't you take that cash out to help you to buy additional property? Can 5 people come together, take their cash out from refinancing and buy an investment property?
That could be a reason that a cash out might be worth it. When I was saying that I'm not a fan of cash out is when people do a cash out to pay credit cards or to pay their car. You know, they're taking a short-term debt and they're putting it on a 30-year. So, but yes, if you're looking to buy an investment property and you have a lot of equity, right now a lot of my clients, what they're doing is they bought a house 5, 6, 7 years ago and the rates are really low. So instead of doing a cash out, they do a home equity line. They take whatever exact amount they need for the down payment on the new house, and then they try to pay off that loan pretty quick.
And if your interest rate currently is like 3%, I want to refinance, I have one for 3 or 4%, and I want to refinance, and I'm going to be giving like 7% interest rate. Would that be advisable?
No, that's why I was saying all these people have lower interest rates because they were able to either refinance or buy when the rates were low. So you don't want to touch ever that rate. You don't want to do anything with that mortgage. Doesn't matter what people tell you. If you have a 3 or 4%, don't touch it. Don't do anything. Okay.
Any question? Any question from the audience? Go ahead.
I just want to draw your attention back to the question the brother asked about combining your income as a self-employed and also as an employee. What qualifies as an income to purchase a property? Having in mind when people change jobs and also probably they've been on a job for just 6 months and then they change jobs. How many years of income qualifies someone to be able to buy a home?
When you work for a company, any type of loan we have to verify 2 years of employment history. But when you work for a company, it's understandable if you're changing jobs for the better. You know, if you change a job a week ago, but you're making more than before, it's acceptable. It doesn't matter that it was less than 30 days, because the underwriter will understand that you're bettering yourself by getting a better job and getting better pay. The thing with self-employment is different because, if you have I don't know, like a laundry or a car wash, and then suddenly you put like a mini market, those are completely different businesses. So the underwriter cannot predict your income because now you have a completely different business. So with the self-employment, it's a little more strict because if you're changing type of business all the time, we don't know, we cannot predict what kind of income that business is going to generate in the future. So self-employment is 2 years, sometimes maybe a little bit less, but it's 2 years. Then when you work for a company, as long as you can show stability and show that you have been getting better jobs, it doesn't matter how long you've been at your current job.
Thank you very much, Mr. Luciano. I have 1 or 2 more questions for you, and then the rest will be by the audience, and if not, we'll be done for the day. To qualify for mortgage loan, what documents are required?
Well, of course, we need your driver's license, we need bank statements, we will need, if you're self-employed, 2 years tax returns. And if you work for a company, just the most recent pay stub and the W-2s. We don't require tax returns for W-2 employees.
So anybody can apply for mortgage? Anybody?
Yes, as long as you have the work history, it's not a problem.
Even students can apply for.
Well, you have to have the 2 years work history. So that but that's a good question because you might have college students. Let's say if you go and study law, and then you come out of college with your law degree, and a law firm hires you, you can buy a house. You don't need to wait for the 2 years because while you're in college, that's considered like it would be work history because you're studying to become what you're doing at the time of application. So the only exception to the 2 year work history is if you were in the university or a college and you are working in something related. High school students don't count. You know, if you're a high school student, you have to have 2 years of work.
Any question? Yes. Yes, ma'am.
Sorry, I would like to draw you back to the income qualification. I'm very particular about that because we've had situations where people have been on a job for 6 months, even 6 months to 1 year, and they are still not able to qualify with that income. Okay, we have situations where people work like 2 to 3 jobs, and probably you are able to qualify for one job. You've been on that job for 2 years, but you haven't been on the second job, which will qualify you for the loan for that amount of time. And we've had bankers and lenders say we're not going to give you the loan. So why is that so?
First, you have to have a loan officer that has experience. The loan officer makes a difference. And I know exactly what you're referring to. I have plenty of clients in those scenarios. The key with 2 jobs is any job you have to, any income that you want to use, you have to think that the guidelines require that it has to be predictable, okay? And if you have 2 jobs, they say that you have to have 2 years because they want to make sure that you are able to sustain 2 jobs at the same time. And I know a lot of, in your community, you work 2 jobs for sure. So as long as you can show that you have 2 years of having 2 jobs at the same time, you're fine. It doesn't have to be the same jobs. The thing is that it has to be continuous. You cannot have a gap in the middle. So as long as you can show, it is fine. The problem is when you have one second job and then there's 3 month gap and then you go back to a second job and then another gap. That's when it's not stable and you cannot predict that it's going to continue. When you have somebody that has one job and it has been less than 6 months or a year, if a lender doesn't want to approve it, you need to talk to somebody else because that's not right.
Thank you, sir. Any more questions?
My question is, if you have been refused loan like maybe once or twice before, does that affect your subsequent application for the loan? If for any reason in the past you've been refused a loan mortgage like once or twice, does that affect your chances the third time out? And if it does, why? How?
No. First, if you have to find out what reason was it that they refused the loan or denied the loan. And I will say to anybody here, if somebody tells you no, don't wait. Go talk to somebody else. Find out why. A lot of times, what I notice is that loan officers or lenders don't explain any reasons to the client. They just tell them that they don't qualify, but they don't tell you why or what, if it's your credit score or if it's your income, or they just tell you no. And so if somebody says no, go get a second opinion. You don't lose anything. And, I would say if they say no, find out exactly why and then work on that so for the next time it wouldn't be an issue. But most times people don't fix what it needs to be done, and then they run into the same problem down the road.
Thank you, sir. The law requires them to explain to you why you are denied. So they have to do that. They will explain to you why they deny your loan. The last question I have for you before I allow the audience to finish up is, for those that have bad credit, how can they build their credit?
Nowadays, all these credit bureaus, they offer, if you sign up with them, they have what is called a what if scenario. So that will allow you to see your credit, see what is, what is wrong or what happened, and then they let you tweak things so you can find out what will be the fastest way to fix your credit. Because a lot of times people assume and say, "Oh, I just need to pay down this, or I need to, pay on time," and they might not realize that they're not doing exactly what is needed to fix their credit. Okay, so I would say, if for any reason your credit is not really good, is go online, use these tools that are available to everybody, and find out what can be done to help you increase your score.
Thank you.
So I have a question on credit that you just talked about. So, just for us, what you see is not your real credit. Like all this Wallet Hub and all these kind of companies, what you see is not what they see on the other side. So when you go to, you want to buy a car, you want to buy a house, what they are seeing is not what you're seeing. So how do you know what to fix? How do you know the what ifs you just talked about?
But that's what I was saying. With a credit, you got to understand that there are different. You have what is called the FICO. FICO is a system that the credit bureaus use to determine your score. But FICO has a lot of versions. So, like Credit Karma uses FICO 8, and banks use FICO 5. So each model of FICO takes in consideration certain things and not others. So, for example, Credit Karma, the issue is that it doesn't look at your medical bills or your collections. So that score is not even going to be close to what I see. So that's why I was saying, you have to go, when you're thinking about fixing your credit, don't go to the Credit Karma or Wallet Hub. Go straight to Equifax, Experience, and TransUnion. Those are the credit agencies that determine your scores, and use their tools to see how you can fix your credit, because that's going to be the most precise.
Thank you, Mr. Luciano. We have just 2 more minutes. One more question. Okay,
Yes,
go
sir.
ahead, please.
Thank you, sir. So, in preparation for buying a house, so 6 months out, a year out, what do you suggest that we do to make sure that we are properly prepared, to be able to buy a property, to be able to buy a house?
First, I would say focus on your credit. Don't miss a payment. Try to keep your balances on your credit cards, between 25 to 30% of your credit, of your limit of your credit card. Focus on that so your score is as high as possible, and that will open you to all the options. Then you can choose what kind of loan you want to do. If you go with a 620 credit score, then you're really limited to maybe one option. And the other, even though there is down payment assistance programs, the more down payment you bring, the better your rate and your payment is going to be. So I would say also focus and try to save as much as you can. Even though there's options without that, you don't have to bring down payment. The better options are when you bring money to the closing. So
Thank you, Mr. Luciano Scala. I appreciate you for honoring our invitation, and thank you for all that you have shared with us. We appreciate you. Audience, I thank you for your participation. It's up to you now. You have been energized, you have been empowered, and if you have not bought a home, it's time for you to start thinking about it. We have agents in the house that will help you. And, for those of you who already own properties, go for more properties. Thank you. God bless you, and have a nice week. Time for celebration service. Thank you.